After double-digit returns last year, the high-yield market continues to perform well on average with corporate balance sheets in a healthy position. High yield is situated well for low but positive growth and inflation coming down toward target. Fundamentals are strong. Credit metrics today look better than the long term. Overall, leverage has come down substantially post-COVID, and companies' ability to service their debt is stronger than pre-pandemic, despite the increase in interest rates over the last few years. High-yield issuers have done a great job proactively refinancing near-term maturities. Defaults remain low. We think they stay at or below the long-term average of 3% in the near term. Demand for high yield is strong, with positive flows into the asset class, particularly into active high yield strategies. So while technicals are supportive and fundamentals are resilient on average, there is growing dispersion between haves and have-nots. This level of dispersion in the market is elevated from a historical perspective, and there's a tail to the market that's facing stress. Pockets of stress are forming within the high yield market, particularly within the wireline, media, and cable sectors. Actively managing exposure in this elevated rate environment offers investors the opportunity to lock in compelling yields. High yield may be able to deliver equity-like returns, but importantly, with yields at these levels, high yield may offer investors the ability to embed more downside protection into their portfolios relative to equity at current valuations. So while spreads are on the tighter end, total yields remain compelling, even on a default-adjusted basis, as all-in yields provide a higher degree of cushion to absorb potential spread widening. Through active security selection, managers can potentially avoid bonds with impairment risk, which is particularly important during periods of slowing economic growth, when dispersion amongst issuers is high, like we see today. With our time-tested investment process and forward-looking approach to credit analysis, PIMCO aims to leverage the structural advantages of active management in the high-yield bond market for the benefit of our clients.